Hello, welcome to Nucleus, another edition of Nucleus Investment Insights. Apologies, we're running a little late this morning. Just wanted to highlight that everything here today is general advice in nature. None of it is personal advice. If you do want personal advice, then feel free to book in for a call and we can chat about your personal circumstances. What I wanted to do today is broadly have a look at the some of the fundamentals behind, like when do you just look at the market and say, okay, it's down X%, or at what level do you look at it and say, okay, look, it's just fallen far enough. And even if it falls further, you're happy to buy in at those prices on sort of some reasonable long-term assumptions. And so what I want to do is run through some of those, what are the key things that we might be looking for in terms of earnings, in terms of dividends, what are some of these long-term valuation metrics that we want to look at, and where do we think you can sort of see where do you think you should be looking for signs, I guess, that are at that bottom. So with no further ado, I'll jump straight into some of these slides. And so I wanted to start with the fundamentals. So we have some long-term data about growth, and I just wanted to highlight what that long-term data shows in terms, so at least we know what we're expecting. So I often talk about equity markets giving this sort of 6 to 9% return that your sort of expectation should be over the long term. And where does that come from? Well, fundamentally, a lot of that comes from earnings growth, and then another chunk of that comes from the dividend yield that you get. And the idea behind that is, look, if you can get a dividend yield of, say, 2 to 3%, whatever that rate might be, depending upon the country, higher in some countries, lower in others, and you're picking up this earnings growth as well, then at a constant valuation metric, so you think over time valuations sort of go up and they go down relative to the earnings. But if you're taking over long periods of time at constant valuation metrics, you're getting, say, a 2% yield and you're getting 6% earnings growth, and that's sort of leading you back to that return where you're ending up with 8% overall. So that's your sort of broad metric about why am I actually getting some return at all on equities, and then what do I expect in the long term from it. It's worth noting, so the chart I've got up is looking at the 50-year average EPS growth sort of over time. So with a view that, like, each one of those periods. So if you're looking at 1950, it's the average EPS growth from 1900 to 1950. And this is US data. So I want to talk about other data in just a little bit. But you can see that sort of, back in the 1950s, 1960s, you're pretty consistently sort of coming out with about 5% earnings per share growth. And you had a much higher yield back at that point. So your dividend yield was much higher. Then over time, that EPS growth has been increasing, and particularly into that sort of 2000s, we saw a reasonable lift in terms of that earnings per share growth. And right now we're sort of running at around about sort of low sixes, sort of call it 6 to 6.5% is sort of your earnings per share growth rate that was sort of seen over quite long periods. Now, I've also broken that out into two other parts. One is the real earnings per share growth, so which is sort of running a little bit above 2% if you look at that. And then the second part is the real pre-tax earnings as well. And the interesting part for that real pre-tax earnings is you've seen that's actually fallen back to pretty close to zero. And a lot of the growth we've seen is really been in financial engineering and tax cuts. So the tax cuts in particular have make up a pretty reasonable chunk of that growth, sort of 2%-ish that you've seen. And a lot of that is that we've sort of come down from, particularly from the sort of 60s and 70s, you've come down from 50% plus corporate tax rates down to 21 is sort of the statutory rate at the moment in the US, and companies themselves tend to pay less than that. And the other thing that sort of flows into this is there is that potential as well for further tax cuts for corporates. It's the mooted sort of level is 15% on US earnings within that, which is sort of then obviously going to bring that keep going with those. So I guess what I'm saying is tax cuts aren't something you can rely on forever, but they are. They have certainly been a feature of the last 50 years, and they don't look like they're stopping at the moment. So it does still look like there's some sort of some more to be squeezed out of that lemon. The other thing is the financial engineering, which in some ways can sound worse than it is. So I do think there's elements of financial engineering where companies are simply gearing up their balance sheet. So just literally adding debt and getting at this sort of supercharged return for equity, but with a commensurate risk on the other side. So some of it is that the debt levels are sort of, I guess, more optimized now than what they ever have been. But a bigger part of it is has been the buybacks. So buybacks used to be illegal, and there's quite sort of strict rules around what you could do as buybacks and what you couldn't do as buybacks. That's no longer the case, and buybacks, particularly in the US, have been growing significantly. And so effectively what US companies are saying to us at the moment is, as an aggregate across all the companies, is that, okay, you buy my shares, I'm going to give you 1.5% as a dividend each year, but I'm also going to buy back sort of 2 to 2.5% of the company every year. So the deal you're getting as an investor is you're getting a 1.5% dividend, and you're getting 2% more of the company every year, or 2 to 2.5% more of the company. So the actual, the amount of money that's being returned to shareholders is pretty close to sort of 4%. And that's why, part of the reason why that EPS growth is now higher, because if you're just getting an extra 2% of the company every year, then even if your earnings do nothing, you're growing at that higher rate of earnings per share. Where am I coming to with this is that that's a new feature that we've only really seen in the last sort of 20 odd years show up, and that's the reason why, looking at the earnings per share growth of sort of 3s or 4%, and now it's sort of 6, is that I'm going, well, I can see why that would be the case if you're going to start buying back shares every year, whereas in the 1950s and 60s, they'll pay out a much higher dividend yield, so they'll be paying out 4 or 5% as a dividend yield. So so it's just how you receive it. And the other thing is that sort of flows back very much, if you look at the Australian market in particular, where there's franked dividends, which sort of very much bias companies towards paying it out as a dividend. And so you see much higher yields in Australia, more like sort of 4% or 4.5% on average. But the flip side is you don't get the same earnings growth. And the reason why you don't get the same earnings growth is because you're not seeing the same level of buybacks. When you adjust for buybacks, a lot of this comes out, year to year, there's big differences, but over a sort of 4 or 5 year period, most of those differences sort of go away on that basis. Okay, so we've got this long-term view. Stocks are going up 6 to 9%. The reason why they're going up is we're assuming valuations stay constant, and we're getting this earnings growth coming through and some sort of yield, which is why we're getting that return. So then it's looking about saying, well, what's the part of that equation? Obviously, is that valuations stay constant, and that's sort of the thing we know doesn't happen over time, and that's why, for example, in our tactical funds, we try to lean in when the markets are expensive. We'll sort of hold fewer stocks and more cash and bonds, and when markets are cheap, then you end up holding more equities. So the question is, how do we get to where valuations are, and where do they sit in the long term? So a pretty common measure that most people, once they're starting to look at long-term earnings, pulls out is this idea of a Shiller PE. And a Shiller PE is effectively saying, I'm just going to take the average of the last 10 years worth of earnings, and I'm going to adjust it for inflation, because the earnings from 10 years ago is not really reflective of what we should be able to buy going forward. And so we adjust it up for inflation, and then I compare it to the current level of the market. And so it's a relatively simple calculation, and that's sort of coming out at 32.2 at the moment. And I've got this chart sort of showing that most of the time in history it's more like 15, and so it just looks horrendously expensive. Looks like it needs to halve to get back to a level which is more reasonable. That's sort of the common way people would look at this. The flip side is accounting standards have changed, and they've changed in a whole bunch of different ways. So buybacks is the big one within this. The Shiller PE doesn't account for buybacks in any. Well, it actually the way that it's calculated ignores that 2% every year. So if you're buying back 2% of companies every year, 2% of the shares every year, this Shiller PE will ignore that. Then it's so and over the course of, if I'm looking back over 10 years, that might be 10-15% of the earnings, as 10-15% of the stock that I need to increase the earnings from 10 years ago. The other thing it doesn't do is it doesn't adjust for tax rates. So we've seen these falling tax rates, and so what it's doing is looking back at earnings from 10 years ago, which is before the last set of Trump tax cuts, and assuming that is a reasonable level to assume. And then the other thing it doesn't do within this, it's not as much of an issue now, but it certainly has been when we look at some of these really low numbers you're getting in the 2000s, in the late 1970s and early 1980s, is that it doesn't adjust for inflation very well. So we've got one inflation adjustment, which is the adjustment to earnings, but we know that earnings themselves, particularly when you're looking at a manufacturing company, can really be thrown out by inflation. And the reason why that's the case is because you build a factory for $100 million, it's going to last you 20 years. So you're depreciating that at $5 million a year every year, over 20 years. But in 20 years' time, when you're about to build a new factory, the cost of building a new factory is no longer 100 million. Now it might be 200 or 300 million. And so you're sort of only writing off this $5 million every year because you've got this 20-year factory, whereas the cost of building a new factory is going to be much, much higher. So that number is understating it. And so you used to have a lot more manufacturing companies, and we had this massive rate of high inflation. And so companies would actually talk about in their earnings releases, they'd say what the inflation adjusted numbers would be and how much lower earnings would be if they actually accounted for the depreciation on a market cost basis rather than an historical cost accounting. And often the numbers would be 50% higher. The earnings would be 50% lower if you took into account some of those factors. So rolling that through, you can adjust this Shiller PE and say, well, what if we did that as a what I've called a cyclically adjusted PE3, which is adjusting for all those differences or most of those differences, and that comes out now at 26.7, which is high but not terrible in terms of the scheme of things. Like it's a level which, because some of the other adjustments have shifted a lot of these numbers all back up again, is that now we're sort of looking more like 15's your sort of low level on this, and the average over that longer period has been in the low 20s. So that's sort of saying on this basis, or low to mid 20s. So if you saw the markets fall another 10-15%, you're back to sort of average long-term levels on a cyclically adjusted PE level. So what is putting that into perspective? At 46 to 4,800, you're back to probably 4,800 say on the S&P 500. You're back to long-term averages. So we're not that far above them if you do it that way. The other thing you can do with this is you can also look at it on a next chart. You can look at it on an excess yield basis. And so how you look at it on the excess yield basis is you take these earnings numbers and you flip them around, flip them upside down. So you're looking at it as a yield now on the earnings, and then you compare that to the real long-term bond rate. And so what that's so the real yield on risk-free assets, and then you're saying, well, how much more am I getting for equities because of that? And now it flips around and it actually looks getting into the stage where it doesn't look anywhere near as bad. You're at sort of 2.6%, which is slightly better than average. over that long-term period, and it's sort of certainly paints a brighter picture for that, in terms of saying, well, on this basis, maybe we're back closer to sort of the longer-term averages already, and and you sort of get some, I guess if markets fall further, it just improves the value that you're looking at over that time frame. If you look at that excess yield and flip it around and say, well, what, if I bought on that basis, what does that actually mean? So I just want to highlight that this is not a great relationship. There is some relationship between the two, but it's basically saying that if you can buy it on whatever a higher yield, you'll probably get a higher return with a an R squared of 0.3. So it's sort of, there's a lot of other factors that this is missing, but it is a relationship, and there's lots of outliers to all that. But that's sort of suggesting, though, that at current levels of if you buy at 2.6, and you're probably going to be getting around about a 3 or 4% return coming out of that, is what this would then say. But a really wide band around that. And so with that, you sort of with this, on this basis, you're probably happier buying at sort of 5% yield rather than rather than 2.5. Okay, so that's the Shiller one. Sort of depending upon how you want to mix that, I guess it's saying another 10 to 15% gets you back to sort of average levels, and take off. So in broad sense terms, we're at 5,200, 5,300 for the S&P 500 at the moment. If it falls back to 46 to 48, you probably, you should be looking to accumulate, and you get back to sort of low 4,000s. You're getting back to the stage where you're saying, well, now we're at stages where it just looks cheap, and based on long-term factors, you'd be wanting to assume that you can buy at those levels without sort of worrying too much about the outlook. Absent a complete meltdown of the world financial system. So if you do a similar type of analysis, looking at forward PEs, now the issue with forward PEs is there's a bunch of different issues with the forward PEs. One is we don't have long time series for it. So we have long time series for historical PEs, and that's what effectively those Shiller ones are doing. You sort of got 100 years plus of that data. Forward PEs are where we say, well, forget what the company earned last year. What's the expectation for the upcoming year? And so we've only had sort of good forecasts for that. Back to the late 90s, I've got here. There are data series I've got that sort of go back into the 80s, into the early 80s. I'm not as convinced of the rigor of that data. When you dig into it, sometimes there's some pretty weird figures that come up. But the broad sense, if you've got sort of at least 25 years of pretty reasonable data, which is what I'm showing here, and this is for the world excluding financials and resources, so coming back to 18.9 times, which is above average. The averages are back closer to 17.5. So you still, you fall 10% from here, still at that sort of 46 to 4,800, and you're back below those averages. And then, if you fell to levels where you're talking about, you took off another 10, 20%, then you're back to levels that are, I guess we haven't really, excluding the financial crisis, you haven't really seen before. Now, there are some other factors that flow into this. Earnings forecasts can definitely change, and they are probably too high, the numbers we're looking at the moment. I would say you'd probably have to knock 10% off at least, the current numbers. Probably 15, I think. And it could, depending upon how things go, it could be worse or better than that, depending upon how extreme Trump gets with his tariffs. It's worth noting that I guess this sort of bottomed out on these forecasts the last couple of times at sort of 15 times. So if you look at sort of the 2015 slowdown, if you look at the 2018 slowdown, and at the post-pandemic, that slowdown, they're sort of all around those levels, and also it didn't stay there for very long. So that's another factor. One more on top of this is that while these are earnings forecasts, they're not forecasts done by strategists. They're all people who are, I guess, looking at how things might change. They're forecasts done by effectively by companies. Analysts will argue that they're doing it, but my argument is that largely it's a clustering around a company number, a company sort of guidance. And the issue is with these is that at turning points, companies aren't good at doing the forecasts, and often that's just because the numbers come from the bottom up, and there's just the people, there's whatever it is, we've grabbed all the salespeople and spoken about what they're expecting and how much they expect to get in the next quarter and what they think they'll hit and what they won't hit, and those people are talking to sort of lower level executives at their companies, and they might not be looking at the tariff side and saying, well, yeah, I'm just expecting to bring this in because that was what I brought in last time. And so you've sort of seen one where I think it was Delta came out overnight. That was one of the airlines, and sort of basically had two sets of guidance: one if there's a recession and one if there's not a recession. So I think I guess it's noting that these numbers are really good when you're into sort of normal situations, but at turning points, these earnings forecasts can get out of whack. But more to the sense that they won't change when maybe they should change. So there'll be the earnings forecast will be slow to change. So sometimes this is just a lag in earnings forecasts that you sort of catch up, that sort of pushes these numbers lower or higher. So that's earnings. If you do a sort of similar analysis on just the US market, you can, so that same US, and again, I just want to highlight this is excluding financials and resources, so it might be different to some of the other numbers you see elsewhere. I do it on a whole bunch of different bases. I think the one I prefer as a more stable series is ex financials and resources, just because they both have their own issues around pricing, and the reasons. In particular, resources. Often when they're trading on a really high PE, that's actually a good sign for the company. It's a sign that earnings are really low, and that and companies aren't expecting earnings to stay low, and vice versa. When they're trading on a really high PEs, it's actually a bad indicator. When they're trading on really low PEs, it's a bad indicator because it's a sign that people don't expect those prices to last. So if you took, for example, the oil price, you've got an oil price producer, the oil price is at $120. And so their earnings look really good. Their earnings are really high, but anyone who's paying for that stock is saying, well, even though I can buy this on a price to earnings ratio of 5 times, I don't want to, because I'm not expecting $130 of oil to stay there. I'm expecting that oil price to come down. And then vice versa, when the oil price hits, $20 or $30, the earnings look terrible, but everyone's factoring in that they won't be there forever. So anyway, on that basis, the numbers are pretty similar for the US, just in terms of what we're talking about in terms of the falls to get you back to sort of more reasonable levels. So that's one way. So that's our forward PE ways of looking at it. Then I want to jump into dividend yields, because that's sort of, I guess it's there's some underlying data there that sort of tells you about when should you be buying, and when you're at the stage where you're like, well, as long as I'm getting a solid dividend yield from this thing and the earnings are growing, then I sort of, in a way, I can ignore the price for a bit as long as I'm sort of getting those fundamentals through. And I'll talk about that just after this message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so I've got a time series up, and I did put this on a log scale because the log scale does work better than the normal scale, and then I ended up reversing it back because it overplays, I think, some of the things that's going on in the 20s or whatever. But I think if you look at the nominal dividends chart on this one, as a good example is showing you, this is, if you bought the S&P 500, what do your dividends look like coming out of that on a per share basis? And then and that series you can see is a relatively smooth series. So there was a big fall in that 2008, but I'll get to that in a minute. But it wasn't, sort of like about a 20% fall. And as you can see in more recent years, it's been more like 5 or 10% fall. And the issue is, I'm sort of coming back to this, is that individual companies, you can go through some massive swings in the dividends. So, if you only own one company and you're relying on that dividend to sort of support your lifestyle going forward, that can cause some real issues when the company decides it's not going to pay dividends because things are bad. And I'd highlight, particularly for Australia, that banks and resources both have those, don't have the same sort of, resources in particular don't have a solid history of returning dividends. Like, you buy resources for capital growth. If you can get a dividend, great, but it's really, I would not be relying at all on dividends from resource companies because, they're more than willing to turn them off when things get tough. Banks are probably a little bit. They are a lot more steady in terms of the dividends, but we have seen the last couple of crises that the banks have shut their dividends. So possibly at the time when you most need it, banks are often going to shut their dividends down to protect their own capital. So okay, so that's those, and then the buybacks as well. The buybacks obviously turns into a much lumpier series. But it is worth noting that this is for the US market. That sort of the buybacks are like, they're 150% of the dividends in recent time periods. So whatever you're getting as a dividend, there's another 150% coming as that buyback, and which is effectively just giving you more of the company every year, and underpinning that growth. So and that flows through for dividends as well. So the idea is that if you're getting if I've just got a 2% yield on the dividend and I've got 2% more of the company, well, I can expect a higher yield next year, growth in that dividend, which is obviously important for if you're using this portfolio to maintain a spending or being able to afford a retirement or afford not to work. Now, I've just put out, this is the 1 year growth in dividends. So we can see, and sorry, just the declines. So you can go, okay, well, if I'm looking at what I'm earning on dividends, and then I'm looking at how much they've declined, I can sort of then work out, well, what could the shock be to my earnings stream if that's what I'm living off in any 1 year. And so certainly in the Great Depression, there was some 30% plus down years. So the decline in dividend was not insubstantial. Outside of the Great Depression, though, the typical downturn sees about 5 to 10% fall in the level of dividends. And the 2008, so the financial crisis, which is one of the most extreme ones, saw a 20% fall. And so while that's bad, I guess it's not terrible in terms of if I'm looking at a cash flow stream and I'm saying, okay, in a massive the biggest extremes of events, in the last 50 years, I'm talking about a 20% decline in my earnings, but it's still there. Let's say I'm getting, well, to make the numbers nice and easy, let's say getting $100,000 in dividends and it falls to $80,000 for a year, but then within a couple of years, it's back over that 100,000, then that's not such a bad outcome. And also as well, if you measure from a 2 or 3 years before, if you sort of look at sort of the more average dividend rate, then the fall doesn't look anywhere near as bad as well. So that 2008 dividend, for example, there was some real growth in that in the couple of years before that. So it had sort of, it was increasing 10, 15% per annum for a couple of years, and then all of a sudden had that massive fall. And so, over a 1 year period, it wasn't good. But if you look back over 2 or 3 years for sort of longer term earners, the decline in dividends was nowhere near as bad. So I'm sorry, that's actually what I'm showing on this next chart. I should have. So that's showing the 5 year average growth of dividends over that time period. And so you're typically getting, that 6% we're talking about is sort of like we sit in the middle of it. But keep in mind, this is a 5-year growth rate. That other one I was talking about was a 50-year growth rate. But the 5-year average growth rate very rarely drops below 0. And so even in the financial crisis, your 5-year average growth rate in dividends, in nominal dividends, not adjusted for inflation, that is, you're above 0 on any time in the last 70 or 80 years. It's not until you go back to the Great Depression where you're seeing actual negative sort of on a 5-year basis. So the idea is, dividends are a pretty good, pretty solid base that we can get, and in terms of holding that value within our portfolio. And then, so the idea is, well, what does that tell us about valuations and how we can look at it? And so, so what I'm talking about within this is, if you look at, say, there's a retirement standard, which is basically how much money do you need to live comfortably. So there's a basic level and a comfortable one. And so as a comfortable portfolio, if you said, okay, at current levels, I want to get a 60-40 portfolio for my retirement, which is 60% stocks and 40% cash and bonds. So you're going to get about a 3% yield on that. And that's going to be growing at about 3%. So I guess I'm just using this as a metric for saying, as if you're investing part of your money in the stock market to get the growth and part of your money in the bond market to get a higher yield, you probably need somewhere between 2 and 2.5 million for a couple, and you've got a comfortable lifestyle and you're not going backwards at all in terms of you're living off your dividends, I guess is the question what people would want to know. And so, yes, that's for a couple is that 2 to 2.5 mil. So, a little bit over $1 million each is that type of level on that. And then you can sort of swing, you can go swings and roundabouts in terms of how you want to go down to whether you want to look at more at a case of drawing down on money and pensions and all these things like this. Like that, if you want to draw it back, say for an Australian retiree, and say, well, how much do you need to make sure you're not going to run out of money under that same basis? It's much lower than that. It's under well under $1 million in terms of that, because there's supplements in terms of pensions and all these other factors that sort of flow into that. I'm just talking about for somebody, quite often I think a lot of people like to look at their wealth and say, how much money do I need to make to live off my dividends and not have to eat into my capital at all? And current market valuations, that's sort of that around about that 2 to 2.5 million. And the lower the market goes, all of a sudden this starts to tick up. The amount of money you need to sort of have set away in that 60-40 portfolio is just less and less. And so, so I think that's sort of for people who are looking at a safety of outcome and saying, how much money do I need as a couple just to put it away and want to know that I can live off that. And there's similar numbers we've got for pensions and allowing for the fact, how much do I need just to make sure I'm not going to run out of money. We do some similar calculations for people on that same basis. Okay, so that's the dividend side. Is it saying, and then so on that basis, that's, I guess I'm talking about this from an investor point of view, more about saying when are you at the stage where you can just sort of say, well, if I lock away and stick a 60-40 portfolio, and maybe my dividends might have a 10 or 20% fall in 1 year or whatever it is, but I know that that's something I can live off, and I can be making those returns. And then as markets fall, that level gets lower and lower in terms of the amount you need to have invested. The other thing then is a discounted cash flow valuation. So this is a little bit more complicated. So let me bring this up so we can see what we're talking about here. So effectively, what this is doing is saying, the value of a business is basically what are the cash flows you can make from that business every year, and then some sort of terminal number at some point in the future. And then you take each cash flow and you go, well, yeah, I think I'm going to earn $100 this year and $110 next year. But, $110 is a year away. So it's not actually, the $110 next year is not worth $110 today. I've got to discount that back at 10%, say. And so it's only worth $100 today. And then, you keep looking every year going forward. And so each year going further and further you go out, the less and less it's worth. So I think I'm going to earn $100 in 20 years' time. That's worth very little to me today as a value. So then there's all these questions and all these movements that go into this. Now, in a broad sense, what we have is a risk-free rate, which is saying, and I put that in here at 4.5%, which is going to be a inflation. What are we expecting for inflation? I've called it 2%, and then some sort of real interest rate. How much is the interest rate above that? Then there's this idea of an equity risk premium. So I'm taking risks on equities. How much extra do I need to be paid for that? And let's call it 5.5, just to make the whole numbers nice and simple. And we're back to a 10% rate on these. So now we sort of start flexing these numbers and saying, well, what do current market levels imply about this? Because based on what these numbers are, you can start making some assumptions about what are the underlying figures beneath this that we need to sort of hit, and at what levels do we, this is this idea that at what level do we actually start to say, I'll be buying the market based on that long-term level. So if you look at the risk-free rate, this is the one of the most difficult ones at the moment. So I've got the 10-year bond here in the US, and we're sort of in the high between 4.5% and 5%, sort of been bouncing around. It's been as low as 4%. Sorry, as low as sorry, that's not right. Yeah, sorry, as low as into the ones in recent time periods, in that sort of COVID period where there's this expectation that interest rates would be really low forever. But we've also sort of been up to 15% back in the early 80s. And so picking a level for this is difficult. You can see that for anyone listening into the chart, anyone listening in and not seeing the chart, in the 1990s, it was 50%, started in the 1990s and the 1980s. And from there, it's basically worked its way all the way down to 1. And then from there, it's sort of come back up to 4.5 at the moment. So, so this broad band that can sort of work out as to say where that can be. But we also have some other figures. We can adjust this for inflation. And that helps us a little bit insofar as we can say, okay, now if I adjust it for inflation, now I've got this idea there's a real interest rate. So what are we actually paying for risk? And so no longer are we looking at sort of 15% back in the 80s. Now we're only looking at 6 or 7. And then currently we're looking sort of round about 2% as the real interest rate. So this is the part which again is difficult to, all these numbers is about trying to work out how do you put, what can you put on these? And for us, it's a lot about flexing the different assumptions and saying, well, if I assume this, what does it actually mean for markets? And if I assume something else. So if you start assuming that we're going to go back to a 6% real interest rate, sort of back similar to the 80s, that's going to smash your valuations. If you want to put those valuations in, you're going to need to halve the assumptions. Actually, let me just bring that up and just double check my maths on those. So yeah, if you wanted to say you're going to have a risk-free rate of say call it 7%, then where are we? 7. Then you sort of all else being equal, you're going to be down about 40% on current market levels. Now, I've put 2.5% into that assumption we had before, so higher than where we are at the moment. Recently, we had negative real yields in recent times. So little bit of a consequence of some of that high inflation we saw, where people are talking about transitory. And which it largely was. It's not all transitory, obviously, but the 6-7% we saw, people were factoring in saying, well, that's not going to last for 10 years. This is going to wash through. So let's call let me work through some of these other factors, and then we'll come back to some of the numbers and sort of these round figures you can look at. Another way to think about the equity risk premium is not that dissimilar to that excess yield from the Shiller PE we were speaking about. And so, and this is the next part, which is what's the equity risk premium? What am I paying over and above? And so over the longer term, we can sort of use this as a sign and say, well, it's somewhere between 2.5 and 7.5. I think is a reasonable sort of range that it's sort of gone in across that time. It's probably not zero. You shouldn't be paying the same amount on bonds as same amount for stocks as what you're paying on bonds. So if you call, that might mean 5% sort of sits at a level, and 5.5% is a level you see from a lot of different studies out there. There's one I've got here from who's this one again? This was Kroll. Kroll, and they were sort of talking about a 5.5%. Had a sort of recent study out. They were talking about a lower risk-free rate than what we have at the moment, sort of 1% lower on the risk-free rate. They're sort of saying you should always be 3.5%, or you're using whatever the spot rate was. That's to sort of factor out those periods where interest rates get really too low. The Bank of England sort of did this big study into option implied equity rate, equity risk premiums, and theirs was more about saying, you're talking well below 5 for the UK and US for long periods of time, but again, that sort of 5% level, there's comes back to that sort of 5% level. Sort of seems to be a reasonable bound where it sits at lower edges of this. If I've the rough maths on this go. Let me pull up my numbers here. So if we put in if you want to get back to the current market levels, and you start with some of those numbers I spoke about, 2% inflation and 2.5% real interest rate, and you can flip those back around if you want. You can have a 2.5% inflation and a 2% real interest rate if you want. That's sort of in that ballpark. If you've got that and you've got a 5.5% equity risk premium, and you're factoring in just that normal long-term growth that you're seeing on companies, then you would. Oh, sorry. Let me try that again. It's a. Let me get back to those the right numbers there. It was a 2.5, 4, and then you had you factored in the normal long-term growth and a little bit of weakness over the next couple of years. That would get you. So you sort of went, okay, I'm going to have say negative 1% earning over the next few years, and then we're going to go back to sort of normal long-term growth rates. That'd get you about market levels at the moment. So where do we flex all these numbers? And so now the question of saying, well, that was a 5.5% equity risk premium. What if I put in a 5% equity risk premium? Okay, now you can justify markets being 10% higher than what they are at the moment. If you need to go to a 6, now you need to get markets to be 10% lower than what they are at the moment. If you start flexing some of these growth figures and saying, well, what happens if we grew at the current market rate what happens if we grew at the rate that markets have factored in already? Now you can add sort of 25% to earnings to the market, maybe even 30% to the market in terms of the upside. So where am I leading to this? It's probably a long and a complicated story, but I guess what I'm saying is on a DCF, there's so many different things you can pull in terms of the levers. But if you saw markets come back to say 4,800, and I'm expecting a little bit of weakness for the next couple of years, and then we just return back to a more normal growth pattern, then now we're talking about risk premiums of sort of 6 to 6.5%. So considerably above what we've seen at any point, any sustained point in the long term. And I think that's where that sort of keeps coming back to those numbers we're talking about in terms of saying, a 10% fall in markets from here gets you back to that 10, 15% fall gets you back to that 46 to 4,800. You're starting to look like it's pretty good value over the longer term. And you get back down closer to the low 4,000s on the S&P. And again, you're getting back to these levels that, yes, they've been around for very short periods of time, but for any sustained length of time, you just haven't seen that type of valuation coming through. One more quick message, and we'll talk about wrap it all up and talk about what it all means.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. Okay. So I'll get to some questions to answer, and I do want to sort of wrap this up in terms of how it all fits together. So I'll run quickly through the questions. Ethan is asking about what I think about cash flow valuations versus earnings valuations. Look, we use cash flow valuations way more than what we use earnings valuations, but the cash flow valuations, particularly for forecasts for aggregate market levels, we don't have as long time series on it, and there's a lot of weird stuff going on within it that can, some companies can really throw out some of the numbers. So I sort of focus on earnings numbers from a broad level, but largely the interesting thing with cash flow numbers is that if we compare cash flow numbers to earnings numbers, particularly 20, 30 years ago, the cash flow numbers were much lower relative to earnings. And because the tech companies have are making up a much larger part of the market, their cash flow earnings are actually really good relative to their market earnings. So from that perspective, there's a pretty decent argument that the earnings quality you're seeing at the moment in the numbers are actually better than what you'd see in the past, just because the makeup of the companies has changed significantly. It's also worth talking about some of the other valuation metrics I sometimes see out there. Price to book ratios, not worth looking at over any length of time. The nature of companies has changed dramatically in terms of what's tangible, what's intangible. So that you're just looking at chalk and cheese. You're not comparing apples with apples if you compare over time, because the types of companies have changed, and also the accounting standards and the way people account for book value has had a radical change in the last 20 years, which just make numbers before that just not comparable. Price to sales is another one, especially people who talk about a lot about the bearish side and about how markets are terribly overpriced and all that type of stuff will often talk about price to sales. Again, for me, not a good measure to look at over longer time periods, because price to sales, effectively, sales ends up, what really matters is how much profit or how much cash you're making. And so it's how much cash you're making divided by your sales. That ratio has changed dramatically over the last 20, 30 years as well. Service companies have much wider margins. Like most of these tech companies have got 30, 40% margins that they make. So they get a dollar worth of sales end up being 40 cents worth of profit for them, and whether you're talking cash or book, profit. Whereas when you're looking at a manufacturing company from 40 years ago, for every dollar worth of profit, you're making 2 or 3 cents dollar worth of sales, you're making 2 or 3 cents worth of profit. So price to sales at a market level over long periods of time is just, not a measure which I think is important. Question from Scott: what are we watching most closely now? How are people behaving? The economy or company earnings? What's giving you clues about where we're headed? So look, we're still in this really rough period where we have forward-looking surveys are terrible. They're at recessionary levels. The current numbers are still fine, and what we're seeing from companies in terms of the numbers are starting to show some concerning signs, but they're dipping. They're not nowhere near the stage where you'd be sort of calling this a terrible outcome. So we're watching. Well, how people are behaving is important, and company earnings. Anything we can get that's as high quality current data as what we can get, whether that's things like credit card spending or things like that sort of flow through. Because and the big question for a lot of people, particularly in the US, is, how much are they allowing the sort of chaos going on to affect them? If they're sort of going, look, things sound bad. There's a lot of screaming voices on financial news and a lot of stuff going on. I don't know how it's going to affect me. I'm just going to keep spending, which I think is what people will do until they start genuinely seeing the price rises. But until we really get a feel for what's going on there, it's everything we can get that's sort of near-term data. There's questions about where's these? Dark says, when investors are selling rips, seems investors are selling rips when markets go up and they're buying dips when they continue to fall. Is this market makers taking the other side of markets or algos? It's a bit of both. There was a lot of people positioned for negative outcomes. I spoke a little bit about this last week. So when you get, they're called CTAs, commodity trading advisors, or momentum investors, really. And it's very similar to technical analysis. Basically, people who buy when they think the market's going up, and while it keeps going up, they keep buying. And then when it turns and hits certain levels, then they start selling and keep pushing around. They tend to get too far on one side or other of the boat. So when markets are falling, they're all clearing out and they're all short and everything like that. And then all of a sudden you get these up days where the market might rise 3 or 4% quickly, and all of these guys have to cover all their shorts so they're not losing money, and they then force it to go up even higher. So there's an argument effectively that market makers generally help. While you've got lots of market makers in there, they'll generally help sort of tame the market at most points. But then the momentum traders will take whatever the trends are and they'll extend them further than what they should go, which is why we're seeing some of these more volatile markets. Market makers, and it's slightly inside baseball, but it's the gamma that they call them gamma flips, which is where the market makers all of a sudden start adding to the volatility as well. And so that's sort of worth watching, particularly on individual stocks. But that's where GameStop and a few of those other ones, that was where market makers went from reducing the volatility of the stock to increasing the volatility of the stock. And sometimes we hit those levels for the market, which is why we see some of these really extreme days on either ways. George is just noting that what I'm doing here is fundamental analysis and the markets are trading on technical analysis. And I don't disagree on a short-term basis. And a lot of this is these commodity trading advisors, and it's a trend is your friend. Yep, keep buying and keep going up. The reason why I'm focusing on the fundamental analysis is because technical analysis absolutely works on some short-term bases. Basically, you're trying to get in front of other investors, and it's all about staying in front of the herd. The issue is the market will come back to their fundamentals. It's this idea that in the it's a Warren Buffett quote, in the short term, markets are a voting machine, and in the long term, they're a weighing machine. It's the idea that if you're not actually getting the earnings coming through, up or down, then things will change. When you start seeing solid earnings, the market will take off. When the earnings are falling, the market will fall back. And so what I'm talking about in terms of these numbers is a great example of the difference between technical and fundamental. Technical might tell you, oh, okay, should I buy today? Should I buy tomorrow? Is it going to be higher in a week or and especially at current points, I think you're probably in shorter time frames. But the fundamental analysis is going to tell you, well, where can I find a reliable bottom? And that's really what I'm trying to get to here is where are we at the stage where you can look at markets and say, look, if I'm buying at say 46, 4,500, which is where we're sort of have our sort of some of these rough markers, is that as long as we're not seeing some massive change in terms of the whole world financial system, if we're just seeing a typical downturn and recovery, then at those levels, you'll be happy in 5 or 10 years. And so if they fall a bit further before they go up, you're still getting enough earnings coming through and enough fundamentals coming through that you can look at sort of longer term ratios and say, yeah, it's going to be fine. Because where we were buying at last year was really a factor of saying, markets were high and expensive, but if you took a positive view on what Trump was going to do to earnings and deregulation and all this growth stuff, you could come up with a reason to be wanting to buy markets. But it was about the growth story that was the reason for doing it. You weren't sort of saying, I'm buying at this level where if the growth story falls away, I'll still be happy. Whereas I think if you get back to those levels where, at least 10% lower, probably 15 to 20% lower, you're getting back to levels where the earnings really are underpinning the value you'll get in the longer term. George talking about fundamental being subjective, depends what you use for the growth rate. It's a modeling exercise. Yeah, absolutely. And particularly those, I spoke about those discounted cash flow ones. I've got a model up online, a blog post we did from a while, just showing how you can double or halve a valuation in the second decimal place, and so you can not even see it by changing some of the assumptions. Particularly, anytime you're seeing discounted cash flows on companies, you can make them anything you want just by changing the assumptions. There's such a broad range of it. But I think for me, it's about saying, look, if you're using pretty reasonable and conservative long-term expectations on these, that was my modeling exercise for this, is saying, now you want to come back to saying, well, what does that imply about market, the risk premium that people have got? And then when you're at levels where you're like, okay, this is a risk premium that markets sometimes reach, but they never stay there, 7%, for example, then you can say, okay, now I'm more than happy to buy with the view that it'll eventually come back to sort of 5% levels. Anyway, thanks for listening in. Hopefully that's given you a feel for what the types of levels we're watching and where we think the fundamentals are following. All of that's subject, obviously, to if the fundamentals get dramatically worse, if you see things like defaulting on US debt or a whole bunch of different range, you get into worldwide tariffs or other things like that, then worldwide tariffs are sort of 20, 30, 40, 50%, then then you might be talking about a different outcome. But in the normal range of outcomes, assuming that this is a typical sort of downturn, and then you'll start seeing stimulus come back in, those are the levels we're watching. So if you want to get more from Nucleus, you can register on our website, and we will send you out every week all our latest blog posts and our podcasts. We're on various social media. If you've got any questions, pop them in the chat or email it through to us. You can get us on all the major and minor podcast platforms, and hit that like button and subscribe if you like what you see and hear. And we will see everyone next week, 12:30 on a Thursday. Thanks.